All of this, I think, signifies the motivation behind those countries around the world that are accumulating metals. And I don't think it ends anytime soon. I don't think, look, the dollar has signaled inflation over austerity, the way that all politicians have forever. And even if we balance the budget today, who the hell is going to pay for our unfunded liabilities? The 77 trillion unfunded in Social Security, 99 trillion in Medicare Part B, Medicare Part D, 20 plus trillion, the pensions, government military pensions, all of these unfunded liabilities on top of a $36 trillion debt, on top of ridiculous fiscal irresponsibility and brain dead monetary policy. This is why central banks are accumulating gold.
Yeah, we all look at this the wrong way around. I mean, the history of gold is, I mean, it was legal money going back to Rome's 12 tables in about 448 BC. That was the first attempt that Rome had at setting up laws which defined our behavior. And in that, they defined the difference between money and credit. Money being something with no counterparty risk, which settles a transaction absolutely and finally, and credit being something with which isn't a final settlement and is always matched by a liability. Someone has the liability. And the situation as far as looking at the value of gold in terms of goods, services, and all the rest of it, is that its purchasing power is broadly unchanged over very, very long periods of time. I mean, I was looking at Diocletian's Edict of Maximum Prices, and the value of these prices in gold, some of them were very, very close to what we see today. I mean, there are others which have dropped out. I mean, we don't have slave markets anymore, for example. There are others where prices have actually, either increased substantially or decreased substantially. But generally, the purchasing power is pretty even the whole way through. And if you look at the purchasing power of gold with respect to West Texas Intermediate oil, I mean, I think I'm right in saying that back in 1950, oil was round about $3.50, $3.53 a barrel. Today it's sort of like 70, but the price in gold has just sort of motored along. I mean, it's gone from 2.5 times what it was then to maybe 50% of what it was then. This is considerably less volatile than any fiat currency. Now, the point I'm trying to make is that when you look at the relationship between gold and dollars, for example, really what you're looking at is not the purchasing power of the dollar so much. Well, you're not looking at the gold price so much, but you're looking at what's happening to the paper currency, the dollar. And the thing about gold is it is international. It is internationally money. It's in everybody's common law, whatever the government propaganda says. And this is why, if you want to vote against the dollar as a foreigner, then your natural place to go actually is to go to gold. And I think that's what's happening. It's not that, say, the PBOC is buying gold. It's more a question that they're selling dollars or they're reducing their dollar liabilities. And that's the way to look at it, I think. That being the case, the only thing that's going to turn around this relationship is a very, very sudden turn in US economic and monetary policy. But so many people will get harmed by that. It's very hard to see that being a deliberate act of policy. But until that happens, I'm afraid the purchasing power of the dollar, and in Steve's word, the least dirty shirt, that's going to continue to decline, and it's going to take the other currencies with it. The other currencies are worse than the dollar. I mean, you can see that in terms of what's happened to the gold price in those currencies. And you look at the euro. I mean, the euro as an international currency seems to have declined in terms of its use in transactions, while the dollar has held relatively steady at around about 50% of all estimated transactions. This is This is, the point I really try and get over is that what is moving is it's not so much the gold price, it's more the value of paper currencies.
So let me, you asked whether we're in the early innings or late innings, and I think we're in the early innings, consistent with what Alasdair said. Because if you look at gold, the price of gold, it should be facing quite a few headwinds now. Actually, the dollar is very strong. Real interest rates are going up. Inflation finally is coming down all over the world, and inflation expectations are coming down. And what's going on? The price is going up. The price of gold is going up. So something is going on that's unusual. And I think Alasdair put his finger on the nub of the problem, is that people are just lightening up on fiat currencies. And by the way, if you look at the World Gold Council, yesterday they came out with the third quarter results. And one interesting thing, we all know that central banks have been buying, and who has not been buying are ETFs, but that changed around in the third quarter. ETF buying is up big time in the third quarter. It's the first time ETF incremental buying has been positive since the first quarter of 2022. So I think we're in the early innings of something going on here. That's basically my bottom line on that.
I do want to touch on a couple of points that both of them said. As far as what Alasdair said, he's right. It's not that gold goes up; it's that the currency that we measure gold in, the fluctuations of those currencies, in particular in the dollar. I did an interview the other day with a gentleman who said to me, Andy, money creation, which is really the definition of inflation from a classical sense. It's always a monetary event. It's an increase, and inflation of the money supply is inflation. Price inflation is a different thing. But when we talk about money creation averaging 7%, I would argue that's a little light, but let's just play that out. He said, for the last decade, it's at 7%. Well, ironically, when we apply the law of 70 seconds to that, which says you take your interest rate and you divide it into 72, and it tells you how long before your principal doubles. So 10 years ago, the dollar was worth twice what it is today by that standard, by money creation alone, by inflation, or pretty darn close to it. And gold was $1,200 an ounce then. So did gold nearly double, or actually just over double, rather? Or did the dollar lose half of its value? I think that's the important thing here, is that gold is the barometer by which we measure the health of the system. And I think the dollar has a long way to go in terms of where it ultimately ends up. It should be much less than it is. The justification for a dollar as strong as it is right now is ludicrous. I mean, we're right at that 120-ish% debt to GDP level, where back when I started in this industry, anything over 100% was a banana republic. And, then you throw into it all the things that I talked about in the previous question, centering around, election integrity and judicial system and all of these things. And you wonder, I mean, isn't that what people used to say was a banana republic? Election interference and debt well over 100% debt to GDP. So we'll sidestep all of that for a moment. But this is one of the reasons why I think you're seeing such a strong drive to gold. I mean, forget about the fact that going back for 25 years, gold has doubled the performance of the 10-year Treasury and has beat the performance of the S&P 500 with dividends reinvested, which has averaged about 9.6%, with gold right around 9.9% for 25 years on average. So its performance is better, but these are assets that have plenty of counterparty risk, as we see, where gold has none. To to Steve's point, I know, Steve, I look like I have such a baby face, but I've actually been doing this for 35 years. And I read that book by Roy Jastrom, The Golden Sexton. And I remember a long time ago something sticking with me in that book. And that was, if I remember correctly, the overwhelming theme that, yes, gold does very well in inflation, but actually does better in a deflationary environment, as it is an asset that has no counterparty liability. And so kind of Richard Russell's old saying, he or she who loses least wins. And having an asset like that maintains no counterparty liability, doesn't have the systemic risk built into it, to me, um, makes it even more valuable than it is in dollar terms. And this is one of the reasons you're seeing the BRICS and all of these countries in the global south accumulate gold, because of the counterparty risk of holding treasuries and because of the irresponsibility in our fiscal policy, which, you know, is very easy to see. And you can understand why these countries are doing what they can to protect themselves. Also, to Steve's point, talking about the strength of gold, even in the face of positive real yield, a strong dollar, and ETF outflows over the last 2 years that have fallen at a 45-degree angle. Now, albeit they are starting to turn up a little bit right now, the large move that we've seen in gold, it was void of American participation. And if you would ask someone who is mainstream oriented and say, what would gold do in an environment of a strong dollar, positive real yield, and massive outflows out of the ETFs, virtually, you know, signaling no participation by the American public, one would think that the price would collapse. And when you look at what happened in Lindsay, Oklahoma last week, with what I would argue is the first bank bail-in that we've seen, where the bank failed, FDIC took it over, 50% of the all of the insured deposits were transferred to the new bank. 50% of the uninsured deposits were transferred, and the other 50% says, well, and they say maybe you'll get it, maybe over the next 4 years, as they unload the assets of the bank. Where earlier in the article they say the assets are far less than the liabilities to creditors and others, whoever others are. But the point is, there hasn't been an awakening yet, a real awakening as to the benefit of holding gold, an asset that is not systemic, an asset that has no counterparty risk, an asset that has outperformed the S&P 500, an asset that has outperformed the 10-year treasury, far contrary to what most people tell you, an asset that doesn't pay a coupon. So what?
Summary. Central banks are actively accumulating gold as a way to reduce dollar liabilities and protect themselves from economic uncertainties. This systematic move is creating significant underlying demand for gold. The motivation appears to be reducing exposure to dollars and seeking a more stable alternative for national financial reserves. The discussion emphasizes the continuous devaluation of paper currencies, particularly the US dollar. Money creation has been averaging around 7% annually, effectively having the dollar's value in a decade. Gold is positioned as a stable store of value that maintains its purchasing power over extremely long periods. Gold serves as a barometer measuring the health of the financial system, with its rising price reflecting the declining value of traditional currencies. There are emerging signs of increased gold investment, particularly a notable shift in exchange-traded fund (ETF) buying. ETF purchases are up significantly in the third quarter and positive for the first time since early 2022. This trend is occurring despite several potential headwinds like a strong dollar, rising real interest rates, and declining inflation, a situation that would traditionally suppress gold prices. This unusual market dynamic suggests we are in the early stages of a potential gold bull market. The overall narrative suggests that gold is gaining momentum due to fundamental economic concerns, loss of confidence in traditional currencies, and a strategic shift by global financial institutions towards more stable, risk-free assets.